All right, let's talk about something that drives investors absolutely crazy, a real paradox. Why do so many people end up losing money in a stock market that, over time, pretty consistently goes up? Today, we're going to break down a simple, super powerful strategy using ETFs that's designed to work for the long haul. We're talking the next 20 years.
It really all comes down to this one question. I mean, think about it. The market trends up. So how is it possible that so many individual investors get burned? Well, the answer usually isn't about picking the wrong companies. It's about market volatility and, our own human emotions getting in the way.
And just look at this. This is the kind of whiplash we've seen in just the last few years. You're down 4%, then you're roaring up 31%. A huge 28% gain is immediately followed by a 20% drop. This is the exact kind of roller coaster that completely short-circuits our ability to think rationally.
And that roller coaster ride? Well, that leads us directly to the core problem we are here to solve today. Let's call it the emotional investing trap.
This is it right here. This is the trap. When the news is amazing and the market's hitting all-time highs, we feel that excitement, that FOMO, and that's when people tend to pour money in, right at the top. But then, when the market does what it always does and eventually drops, that fear kicks in and people sell to stop the bleeding. It's a cycle of buying high and selling low, and it's basically a guaranteed way to lose money. So, the big question is, how do we beat this emotional trap? Well, it starts with using the right tool for the job. And for most of us who are investing for the long term, that tool is the exchange-traded fund, or ETF.
Let me break this down. Buying a single stock, say McDonald's, is like putting all your faith in one company. If they have a rough year, you have a rough year. But with an ETF, you're buying a tiny little piece of hundreds or even thousands of companies all at once. So if one of those companies stumbles, its impact is cushioned by all the others. It's just simple, automatic diversification.
So yeah, to put it simply, an ETF is just that, a pre-made basket of stocks. It is one of the easiest, most efficient ways to spread out your risk and buy an entire market or an entire industry with just a single click.
Okay, now that we've got that foundation down, let's actually start building our 20-year portfolio. The first and honestly the most important layer is your core, the broad economy ETFs. These are your heavy hitters. You can literally bet on the entire world economy with an ETF like VT, or you could focus just on the US with VTI. You can also zoom in on the 500 biggest US players with SPY, or take a more tech-heavy approach with QQQ, which tracks the biggest companies on the NASDAQ. Just think of these as your main set-it-and-forget-it building block.
Okay, next up, on top of that solid core, we can start to expand our horizons a bit. We can add in some ETFs that are focused on generating income and giving us some real global diversification.
Now, for anyone who wants to build a stream of cash flow from their investments, dividend ETFs are an amazing tool. These funds basically just buy companies that regularly pay out a slice of their profits directly to you, the shareholder. Now, this is definitely a long-term play. You need patience, but over time, this can build into a really powerful passive income machine.
It's also a really good idea to look outside the US for growth. I mean, you don't want to put all your eggs in one country's basket, right? You can buy the whole world minus the US with the ex-US, or focus on more stable, developed countries with VEA. Or you can tap into faster growing, but also riskier, emerging markets like Brazil, India, and China with VWO.
Okay, our portfolio is really starting to take shape. The final pieces of the puzzle are all about balancing risk. We're going to add a little protection for the bad times and a few targeted bets for some extra growth.
So this is a really key concept. An ETF like GLD, which tracks gold, isn't meant to make you rich. You need to think of it more like portfolio insurance. It doesn't really grow or make profits, but when investors get nervous and scared about the economy, they often run to gold for safety, and that can help cushion your portfolio when the stock market takes a nosedive.
And then on the complete flip side of protection, you've got your risk-on investments. This is where you make a specific, targeted bet on an industry you really believe in. Maybe you think the semiconductor industry is going to boom, so you look at SOXX. Or maybe you think the future is quantum computing, so you check out QTM. Look, this is way more speculative and definitely higher risk. But it also offers the chance for much higher growth if your bet pays off.
So, we have the tools, right? We have all these different types of ETFs. But the best tools in the world are pretty much useless without the right strategy. And the winning mindset, the whole thing, can be summed up in just 3 simple letters.
It's a three-letter mantra that just completely flips the script on emotional investing. And the first letter is A, for
Always be.
Buying. ABB. Always be buying. This simple little mantra is the secret weapon that helps you defeat that emotional trap we talked about at the very beginning.
What it means is you create a system. Every week, or every 2 weeks whenever you get paid, a set amount of money is automatically invested. You don't check the news, you don't try to guess what the market's going to do, you just buy. And this means when the market drops 20%, you're not panicking, you're automatically buying your favorite ETFs on sale. That consistency is how you turn volatility from your biggest enemy into your greatest advantage.
ultimately, when you've got the right tools, the ETFs, and the right mindset, always be buying, you can totally reframe the entire experience of investing. So I'll just leave you with this one question. The next time the market inevitably crashes, are you going to join the panic, or are you going to calmly see the opportunity that almost everyone else is missing?